Hey, friends. So, welcome to the fourth edition of Viewer Question Friday, where I will attempt to release a video once a week. Feel free to submit your question in the Google form, which will be in the video description below. And with that, I'm going to get straight into this week's question. Okay, so this week's question comes from M, and they asked a really good question, which I'm excited to answer. So, I'll open the question here. And so the question is, could you walk through the difference between dividend yield, dividend growth ratios, and share appreciation? Which is more important when comparing similar ETFs for long term investing? And then lastly, if I have a portfolio built with one strategy, but later want to generate monthly retirement income, why not just convert to a dividend focused fund then? I really appreciate how you answer Friday questions with clarity and free of judgment. That makes me smile. I'm glad that hopefully that comes off in the content I produce. So I appreciate the compliment. And again, with all these answers, I'm just going to give you my personal take and the way I see the investing world and the world in general. And hopefully that's helpful for you. There's certainly more than one way to invest. In fact, I would say if you ask anybody about investing, you're going to get a million different answers, and no one way is the definitive right way. I think what's most important when you're investing is one, you have a simple plan that you are able to follow consistently over the long term. Two, that you really understand what you're investing in so that if you had to describe what it is that you're putting money into, it's something that you understand and get excited about. And then three, that kind of leads into another thing that I'll say often, which is that you have conviction in what you're investing in. Because I think what's more important is that you stick to a plan that you're excited about. If you are investing in something that maybe someone else said you should invest in, but you don't really understand it, you're not that excited about it. When you start to see prices fall as the stock market goes down, then you get into a situation where you just feel like you're losing money. And then you can capitulate, which is the idea that you're going to turn tail and run from whatever investment you're in, when that's really the worst time that you can sell something. Okay, so I'm going to answer this question a few different ways. One, I'll just answer what was asked directly, and then I'll also just add some commentary around some things that I think people are actually asking when we talk about dividends, and just give you my opinion on them at various times in our investing lifetimes. So, okay, so the question was, what's the difference between a dividend yield and a dividend growth rate? So, a dividend yield is just looking at how much capital is being returned to an investor, either on a monthly basis or a quarterly basis. So, for instance, you might be able to calculate a dividend yield at like an annual 4% rate. So, what that would mean is that you have 4% of the capital or money that you've invested in a stock returning back to you in the form of dividends. And I built a little calculator that I'll show you a little bit later in the video. So I'll show you how to calculate that yield based on the stock price. Okay, so then the dividend growth rate, what that's looking at is how quickly is the dividend growing over time. And the reason that's important is because investors that are focused on dividends are typically one wanting to make sure that the dividend's going up. A lot of different funds will look at how quickly is a yield growing as a way to determine viability for investing in the fund. Now, there's a little bit of nuance here because you could hypothetically say, well, why not have a 10% yield or 15% yield? Or why not just grow the yield by a large percentage every single year? So that can be what's known as a yield trap. And so a yield trap is something where you, let's say, invest $100 and they're paying you $10 a year, which would be 10% of the money that you put in. That can sound really good. It's like, okay, I put in $100 and now I have this income of $10. I'm making a 10% yield every single year, and that's so much better than I can get in a bank account. The problem is that typically what's going to happen is the underlying asset, that $100 that you put into this company, that's going to become worth less and less and less over time. So the size of the yield and the rate of growth in the dividend by themselves, in my opinion, are not really the correct way to value a company when it comes to deciding if it's something that you want to invest in. Okay, so that's part one of just explaining what those things are. Now, what you'll also find when you start researching on whether I should invest in dividend companies or just growth companies or whatever else I want to put my money into, you're going to find two camps typically online, and they each have very strong opinions about dividends. And I actually like dividends, and I'll get into why I like dividends a little bit later, but mainly because at least for me, I think that dividends help emotionally with making good decisions when investing. Not necessarily that the dividends themselves really make a difference more academically around long-term performance. And so let me just show you a few different things on my new digital whiteboard. I got a few complaints on my one of my last videos about using an actual whiteboard. So I'll retire that for now and see if maybe the digital whiteboard does better. But there's a theory called the dividend irrelevance theory. And what it says is basically when you're valuing a stock, the dividend payout shouldn't matter one way or the other. And so you can see this when a stock pays a dividend. So let me just use a hypothetical example. Let's say a stock is worth $10 and they pay a 50-cent dividend. What this is going to say is basically that 50-cent dividend, which is being returned to an investor, the stock itself will then be valued at $9.50. Now, let's say you're just an individual investor and you're invested in a $10 stock that doesn't pay a dividend. So that $10, it doesn't decrease because it paid a dividend, but you wanted to use money from your investment. Well, you could basically sell a portion of the stock to create your own dividend. And so if you're in retirement, which I know this question asked about, even if the company doesn't offer a dividend, so for the amount of this 50 cents, and you're left with the $9.50 in total value for the stock. So the question might be, okay, so if a company that creates a dividend and pays it to me, if I took that dividend and reinvested it back into that same company, do I end up at the same place as a company that doesn't pay a dividend that I just let grow over time? And for that, let me jump into the portfolio visualizer tool where we're going to be able to look at a few different funds. One that's more focused on dividends, and then one that's more focused on just the total growth of the stock market. Okay, so now the second part of the question was what's better, looking at dividends or looking at the total stock growth of the stock market? Okay, so let's say you use the word long term. So let's say you're going to be investing for 20 or 30 years. What's most important in that setup, at least for me, is I'm looking at share appreciation, which I think was the phrase used in the question. So what I'm going to look at, how can I capture the most of the stock market as possible? What I'm going to look at is a fund like VTI. So VTI is Vanguard's total stock market index fund. And it is what I built the majority of my wealth with. Like there's really nothing more to it than for me just buying the US total stock market and letting it grow over time. Okay, so I'm going to put aside the idea of investing internationally for a second. So you can just build a portfolio that is only invested in the US stock market. That's what I did as I was growing my assets. I did not invest internationally. Now in retirement, I'm starting to look at things a little bit differently. I'm starting to look more defensively at the way I think about both preserving my portfolio over time on the equity side and how much I have in equities in general in the stock market. But putting aside international investing, really what you're trying to look at with your equities is how can I have the maximum price appreciation while being diversified and spreading my bets across as many companies as possible. And that's basically what VTI does in a very low cost way. So it's simple and easy. And you're really just following the average of the market over time. So in bad times, that means it goes down. And then in good times, it goes up. So going back to the question, should you focus on price appreciation or dividends? I've also included a fund here, VIM, and I like VIM. This is a dividend focused fund from Vanguard. And what I've done is I've plotted this over the last from 2007 to 2025. So what is that? That's 18 years. And what you can see is that really from 2007, my whiteboard is not working that well with the click, to 2020, really they performed almost the same. So a few things about this back test, and this is what we're doing is we're back testing data. So we're looking at these stock symbols and the funds that and the companies that they hold, and we're looking at how did these funds do over time. Now, you can't look at back tests and then say into the future this is what's going to happen. You'll hear financial advisors or funds say past performance is not indicative of future results. And all that's saying is basically we can't use anything that we're looking at here to know the future. And that can be a really tricky thing to learn, especially when you're new. And I still get in the habit of trying to not do that. So, anyways, VIM is a dividend focused fund. And what Portfolio Visualizer or Testfolio will do is they will reinvest the dividends back into the fund. So in the whiteboard example where I showed you like a hypothetical company that issues a 50-cent dividend, the stock goes down. But if you were to take that money and reinvest it, that's basically what's happening here. And so really from 2007 to 2020, so 13 years, they performed the same. From 2020 to 2025, you can see that VTI, which is the total stock market in red, really started to take off and outperform VIM, which is a dividend focused fund. Okay, so the next part is if you are someone that's accumulating money or accumulating wealth, so you're investing in the stock market consistently. You set a goal. I want to be a millionaire in 20 or 30 years. One of the drawbacks to dividends, and this isn't just looking at the companies themselves, is as a dividend is distributed to you, you're going to pay tax on that dividend. And if you're an accumulator, you don't really want that income because you're trying to grow that. And so even if you're getting paid a dividend and you're reinvesting it back into the fund, you're going to pay tax on all of that unless it's in a tax advantaged account like a Roth IRA, your 401k, or a traditional IRA, which I have a video out on different accounts, which is like really step one of investing as a separate video, which you can watch that kind of talks about the different accounts. But if you just have a taxable brokerage account that you just opened at Fidelity or Vanguard or Charles Schwab and you bought them, then every single quarter they pay a dividend, you're going to pay tax on that income. The advantage of VTI is that they're going to pay a very small dividend compared to a dividend focused fund, and so you're not paying tax on those income payments. Okay, so a few other things I want to call out. I think there can be a misconception about dividend funds that because they pay a dividend, they're safer than other equities. So what you can see here from 2007 to 2025 is that the max drawdown, which means how much did that fund drop, you can actually see that VIM as a fund, it dropped by 56%. Now, personally, putting aside the math, I do think that a dividend fund, especially for a new investor, I think there's a lot of comfort in dividends because even though the fund or the share price drops by the amount of the dividend when it pays out, the fact that if you're down already and you get a dividend, that you still have income and you're holding the same number of shares as before the dividend, and you're able to rebuy into a fund with the dividend that you were given, I think that gives you a sense of control. Whereas if you're sitting in VTI in the total stock market and you get a 55% drop and you have no dividend, even though you can conceptually tell yourself, well, I know that the growth for the total stock market is going to be higher because it's not paying a dividend, and it really kind of nets out in the end. I think emotionally for an investor, it's harder to stay the course with your investment decision. Potentially, this can be a potential emotional and behavioral issue where now you're feeling like, oh, I'm selling shares of my funds when it's down. The question is will that keep you up at night? That's always one of the main questions to ask yourself is, are my investments stressing me out to the point where I can't sleep at night? If dividend investing, even though the dividend at the end of the day doesn't really make a difference between the growth of your investment, but it gives you comfort because it feels like you have an income and you have more control. then it could stop you from making bad emotional behavioral decisions like selling out of a fund when you do get a big drawdown like this. So I like dividend funds more for the behavioral feedback and the emotional feedback that might allow you to stay the course. In the end, does a dividend actually matter? Not really. It's going to do the same thing whether you have a growth focused fund or a total stock market fund like VTI and you just hold or decide to sell when you need money. It's going to kind of do the same thing for you. Now, the part that gets missed by a lot of people, this is really key, is that what's a better question to ask in any investment is what are these funds actually investing in? So if I go to VTI on ETF.com, what's helpful to see is basically what is VTI holding? And at a real simple level, the way an index fund works for like the total stock market is it's just weighting the size of the investment in each company based on the market cap of a company. And the market cap is basically the total value of that company's shares. And so as a company grows and its stock gets more and more valuable, the index fund is going to dynamically change its allocations of each company to match the actual size of those companies in relation to every other company in the market. So there's about, last time I checked, around 5,500 companies in the total stock market. And so what you'll see here is Nvidia, for instance, is almost 7% of the total stock market. So it's a huge piece of the pie because the company is currently valued so high. And that will cause some people to freak out because you might ask, is Nvidia overvalued? You also look at the other top holdings in the total stock market right now. It's Microsoft, Apple, Amazon, Facebook or Meta, and Alphabet, which is Google, and Tesla. And so if you add all that together, and in fact, it tells you here the top 10 weight of all of these top 10 companies is 1/3 of the entire market. When we go back here and we look at the performance since 2020, well, what's happened since 2020? These large or gigantic technology stocks have done very, very well. And so the question might be, will those gigantic technology stocks continue to go up or are they overpriced and will it come back down? And nobody knows the answer to that. You'll hear a lot of analysis around what people think will happen. The answer is nobody really knows. And that's why I've always just bought the total stock market because I just don't know. And I don't want to spend the time trying to guess and maybe be right, maybe be wrong. I just like buying the total stock market and I just let that ride over 20 or 30 years, understanding that over time, the stock market has always went up. Now, when you buy a dividend fund, I'm going to go to Schwab's US Dividend Equity ETF, which is SCHD, which is a fund that I really actually do like. But it's not necessarily because of the dividend. What you can see is that dividend paying companies are much different than the total stock market. So typically, companies that pay dividends are going to be older, more mature. They're not going to be as growth focused as like a technology company. And so if I look at the top 10 holdings of HD, it's things like Home Depot and Verizon and Pepsi or Chevron. These are not really exciting companies. It's not the future of electric cars like Tesla or the future of AI like Nvidia, but they're more stable, older companies that you hope are going to be almost safer bets. But the truth is that if we go back and we look over time, I'm sure I could do a back test and look at periods in time where technology funds did bad and these more defensive stocks did well. And so then you could kind of say, well, maybe a dividend fund is better. And that's where I go back to my original point in the video at the beginning is if you have conviction in what you're investing in and you're happy with it, and when it's going down, you're okay with it, and when it's going up, you're happy, but you're staying consistent over time. I think that's more important. The one other thing I would call out is that really for a very long period of time, these dividend funds, whether it's Schwab's or Vim, they've performed very similarly to the total stock market, especially when you reinvest dividends back into them. And in a way, it doesn't matter as much. Now, like one thing I would call out about Schwab's US dividend fund, if you are An investor that's scared of the top 10 holdings being overweighted, meaning they carry so much weight in the total fund. Well, you look at Schwab, its top 10 holdings hold 42% of the entire fund. So if the weighting of the top 10 freaks you out here, it might freak you out over here, maybe not, because you have more confidence in these funds, but that's something I would look out for when you're choosing your funds. I do want to show you Morningstar. So I really do like Morningstar's analysis on things. So if you're ever interested in a specific ETF or mutual fund, you can come here. I like this portfolio section and the stock style. And so here I'm on Schwab's US Dividend Equity Fund, and I go to map under stock style. What you can see is that Schwab's fund, it's a large cap fund. And so that means that the companies that it's invested in are over $10 billion in value, according to their stock price and outstanding shares. And they're more focused in this value area. So they're large cap companies focused on value over growth. And so value tends to do well in more defensive investing environments. People also argue that a value company may be undervalued. So the idea that it's cheaper to buy earnings in that company versus some growth funds. If you look at things like Tesla or Palantir, these tech companies, they're so growth focused, meaning that investors believe that they are set to grow over a long period of time. If I go to Vanguard's total stock market fund, the total stock market is more balanced towards the growth side. And when you look at the size of these companies, the total stock market's going to be heavily weighted towards these giant companies. And the average size of each company is like $254 billion. Obviously, the average of the top 10 holdings are much larger. So essentially what you're doing with a dividend fund is you're tilting towards higher yield and income and companies that are slower growing and older, but are thought of as more stable. And again, that doesn't mean that they don't decline in value. In fact, when we go back to the back test, again, we see that the max drawdown of this dividend fund fell in conjunction with the total stock market. One thing I think it would be amiss to not cover. The other thing I do like about dividend funds and dividend companies, not because again they pay a dividend, but because they're more defensive and older, is that a lot of times they are able to weather financial storms better. And where you can see this, you can't really see it in this back test, but what can happen is dividends can be cut in recessions. And so the fear is that you start depending on those dividends for income, for instance, like in retirement, and then those dividends cut and then you don't have the income anymore. But what's been shown over time is that many times dividends actually are less volatile, meaning they go down less than the underlying stock price. So one thing I like is that, let's say you're back here in 2008 and you're going through this great financial crisis, and let's say I actually kind of like this because it starts during one of the worst crises. So let's say you were retiring and you just started your retirement and now you're down to $5,000. So your retirement money got cut in half. Well, if you're in a dividend fund during this time, the dividends did get reduced, but them, for instance, this dividend fund, its dividend got cut by like 25%. So if you're a total stock market investor and you're going through this crash and your VTI, your total stock market value, has been cut in half and you're having to sell shares while you're going through this, that would cause me to lose some sleep at night. With them, yes, my dividend might have got cut by 25%. So maybe that means that during retirement, I get to do 25% less than what I'd like to do. But I still might sleep better at night knowing that I still have that income coming in, even though the underlying asset, the stock price, is falling much more. I might not care if I'm getting that dividend because that means that I have income to support my needs. So again, that goes back to kind of the emotional and behavioral elements of dividends that I actually really like. Okay, so hopefully that starts to help the question of, should I be focused on just overall stock growth, which in my opinion, if you're just starting your journey and you have 20 or more years to invest, that's really what you should be focused on, especially because dividends are going to create tax impacts that you shouldn't be spending that income as you're trying to build it anyways. That's really just paying taxes for the sake of paying taxes, in my opinion. But then the second question was really around, what if I want to change to a dividend fund in retirement? I think retirement is a completely different story because it gets into, how do I have my assets generate consistent returns for me over time? One of the things that I think is a little bit misunderstood with dividend funds is you might think that dividend funds are less risky when really they're not. And I'm going to show you a chart that I need to attribute. He has an incredible financial YouTube channel that, and I'll share it in this video. But he put this chart together that shows basically the range of annual returns since I think 1928 to maybe 2024. So you get almost 100 years of data. And what you can see, I love this chart, is that you can see that the annual return for US stocks can range anywhere from like negative 50% to upwards of 50 or 60% in a year. So when you're in retirement, what you're really trying to do is you're trying to balance the level of risk that you need to take to ensure the longevity of your retirement. So it's almost like the better question is, what should be my ratio of stocks to bonds in retirement so that I'm able to kind of de-risk my portfolio so that I'm not risking these huge swings down here because I can't afford to take the risk because I'm trying to protect the money that I have. Or the better statement is, I already have enough money because I'm working a financial goal and I've gotten to the place where I have enough. Now I'm just going to be drawing from the enough money that I have over time. The worst thing that could happen is I risk more than I'm capable of losing in retirement, and now I've fundamentally kind of broken my retirement. So dividend funds and drawing income from dividends really fall into this portion of US stocks. It doesn't mean that you're de-risking your portfolio by switching to dividend stocks, which I think can be kind of a hard thing in a way to understand, because it seems like you're just making kind of free income in a way. So I'll just browse through this article briefly, and I'll link it in the video description. But I think a better way of looking at retirement is thinking about the percentage of your total portfolio in bonds versus a split between growth stocks versus dividend stocks. Because at the end of the day, it's all going to lump into your equities stock bucket, which is just riskier than bonds. Bonds are really IOUs, whether it's an IOU from a company or it's an IOU from a government. A stock is really just an investment into the business itself. So you get to share in the earnings of that company, but there's no promise of earnings. A bond has, it is a contract. It's saying, you give me this money, I'm going to use it for something in my business or in the government, and then I'm going to give you that money back plus interest. Doesn't mean that like corporate bonds or company bonds can't fail. In fact, in 2008, they did. But they still are not as volatile as stocks by a wide margin. So to just kind of go through this article pretty quickly, what you can kind of see is that during different time periods, what you want to hope happens with your portfolio is that if equities go down, like you see in the dot-com crash in 2001 and 2002, bonds actually went up. And so the idea is okay, so my stocks are going down, but I have this buffer with bonds that are providing me income. They are being less volatile than the stock portion of my portfolio. Now, one thing I'll call out, I think this is why you're seeing so much discussion around dividend funds, is that in 2022, because of the rising rate environment in the United States, what's happening to bond funds is they're getting less and less valuable because the new bonds that are being issued have a higher interest rate. And so as interest rates are climbing, the value of existing bonds that have lower interest rates than the new ones are less valuable. And so, for instance, like my bond fund, BND, had a huge dip in 2022. And so what's not supposed to happen, or what you hope doesn't happen, is bonds fall at the same time equities do. And what you can see in 2022 is that actually bonds fell worse than stocks while stocks were falling. So this is like a double whammy. And you can kind of see in every other period, you didn't have that happening. You didn't have bonds falling while equities were falling. And that's because we're in this rising rate environment. And you'll see people say, well, this is just a one off. That'll never happen again. But it does leave a bad taste in your mouth when you think about bonds being this safe, secure thing that don't increase in value very significantly, but you're depending on them to be less volatile. And so I think that's where you have people asking, well, what if I just invest in dividends instead? And I try to get my income from there. Okay, but putting aside 2022 and 2021, let's go through some other things that I think are really helpful here. So correlation, you really want to understand correlation when you get into investing. And the idea is you want in your portfolio assets that are negatively correlated. And what negative correlation means is as one thing goes up, the other thing goes the other way. Now, in a way, that means that as one thing goes up, the other thing goes down. So you always kind of have a loser in your portfolio, but you want that. That's what's really happening with diversification is you're kind of spreading your bets across different assets so that you don't have all your eggs in one basket. In past recessions or in past declines, you've seen that they are negatively correlated and bonds are doing what they're supposed to be doing. Okay, so I think this last chart is helpful to kind of go through. So here you can kind of see during different crises how correlated were stocks versus bonds. In 2022, it was really the worst case situation because you had positive correlation. You had, let's see, your equity on the x-axis, bond returns on the y-axis. Here you kind of see, okay, my equities have decreased by 25% and my bonds have fallen by 13 or 14%. But you compare that to other crises, the dot-com crash is a great example. Equities fell by almost 45 or 50%. So if you're a retiree and you lose half of the value of your retirement fund as you're going into retirement, that's going to cause you some sleepless nights. But here you can see that your bonds actually increased by 20 or 30% over that time period. So the idea in retirement is really that you're offsetting risk with bonds. So as long as you're not really making the mistake that you think that a dividend fund is acting as a bond when really it's just as risky because it is a company, then I think it's okay. Now, the final thing I'll show you is I built this little calculator. So what this is going to show you is just these different dividend funds. So I have one that's an international fund. I have one that's a US company dividend fund. I have another international dividend fund. I have bonds and I have the total stock market. So what you can see in column G here is that they all carry different annual yields, which I calculated out. So here I have this international dividend fund. To buy one share of it, it's $28.19. What this yield is saying is that for every share, they'll pay out 34 cents quarterly. And so what I did is I calculated the annual payout for one share. So if you bought $28 worth of this fund, they would give you $1.39 a year. So if you calculate basically the cost of the share with the annual payout, that's how I got to the yield. And then here I just basically divided the quarterly payout by 12, which is the obviously number of months in a year. So each share nets you about 12 cents a month. So to generate a dollar in dividends, you would have to buy $242 of this company. And then I just kind of did this other fun stuff. So I said, well, how much would I have to invest in this fund to generate $1,000 dividend? Versus what if I wanted $2,000 of income or $3,000 of income or $4,000 in income? So what you can see is that VTI, the total stock market, it includes all of these other dividend companies because they are US companies, if you're looking at US dividends. But then it includes all of the other companies that don't pay dividends, which you do want because that diversifies the total number of holdings and different sectors that you're invested in. But because it includes all companies, including companies that don't pay dividends, its dividend only pays about 1% a year. And so if you wanted to, let's say, create a dividend with the total stock market, you would need almost $4 million to generate $4,000 a month in income. So let's say you're a retiree and you're thinking about, I have this $1 million and I want to invest in dividends, I want to invest in bonds, and then I just want growth in the total stock market as well. So You could do this a lot of different ways. So here's kind of the conventional way of doing it. So like let's say you're 60% invested in the stock market and you have 40% of your money in bonds. That means that you have $600,000 in stocks, $400,000 in bonds. Together, that generates you $1,879 a month in dividends by itself. Annually, that means that basically if you're pulling those dividends out of your funds and you're not reinvesting them, you're taking about 23,000 just to round up, or 2.26% of your total portfolio. Okay. So kind of the conventional rule of thumb is that for a retirement of 30 years, you can draw up to 4% of a portfolio and live off of it safely. So in this situation, if you don't have your money in dividend funds and you just wanted to create your own dividend and create your own income, what you would do is basically sell out of your investment to get up to the 4%. So let's just do this. So if I have my 4% rule, that is $1 million times 4%. That means that I can draw $40,000 a year out of my fund. So then what that would mean is that I would basically sell $17,443 worth of my investments. So let's say you didn't want to sell your investments and instead you're going to in dividends and you want to generate income without having to sell. In a way, you can just think about that as companies returning the money that you've put into them back to you. Let's say you decreased your growth of your total stock market down to 30% and you invested in 30% of dividend funds. So here, basically, you've increased the amount of income you're generating up to about $2,538. And you're still not at the 4% rule with your dividends. If you still didn't want to sell, let's say you decreased the total stock market by down to 10%, and now you increase your dividend fund up to 50%. You can kind of see what's happening here. It's increasing the total income that's being paid out every month. What's really important is not necessarily whether you're selling the stock or you're having companies pay you a dividend. What's more important to look at is what is the total percentage of the draw on your portfolio that you're having with this income. And that's really what to look at, while also balancing your bonds to stock ratio to manage the risk of the US equities that you have. What you wouldn't want to do is get rid of your bonds altogether. And let's just say I'm going to invest 40% of my money into international dividend payers. Now I have $40,000 of income being generated, which is over the 4% rule. But then I wouldn't want to think that this is basically as safe, because now you're 100% invested into equities, which is fine when you're first starting and you have a 30-year time horizon. But for me, I wouldn't want to put this much risk on a retirement portfolio. The thing that you would have to do, and again, I'm not a financial advisor, this is just my understanding of it, is that if you were to do something this risky, you would have to be flexible with the amount of income that you would draw on the portfolio every month. And that's what's known as a variable withdrawal method. And so what you might want to do to avoid the sequence of return risk where you're drawing on funds that go down, let's say your dividend funds went down by 50%, like we've talked about. Even if the dividends didn't decrease as much, you would want to decrease the amount of income that you're drawing from the portfolio in periods where the portfolio is heavily down. And then with a variable withdrawal method, what you would want to do is in periods where returns are much higher, you could actually spend more. So that's one way of kind of defeating the risk of drawing on portfolios too much early in retirement when stocks are falling. And that methodology doesn't really change whether you're using dividends or just stock growth. Okay, so that wraps Viewer Question Friday. Obviously, I spent a lot of time answering this one question. Future weeks, we'll attempt to just answer one or two questions. And as a reminder, if you have a question, just drop it in the Google form in the video description, and I'd be happy to answer it. So I hope you have a great weekend. And if you have any questions or feedback, or if I missed something, feel free to leave it in the comments. I read everyone, and I appreciate the conversations. Thanks.